If you are waiting for cheaper loans, RBI just killed that hope. Does that mean we are stuck with high EMIs till 2027? Listen till the end, because once you understand this, you will know exactly how to position your money for the next 3 years, while most people keep waiting and lose. What just happened is not a small policy segment, it is a cycle level message. The Reserve Bank of India is not just deciding the interest rate for the next few months, it is shaping the entire financial environment for the next 2 to 3 years. And the biggest mistake most people will make right now is assuming everything is temporary. It is not. So, at a surface level, it looks confusing. Inflation has started to cool down, growth is stable, so logically, rates should be falling. But central banks don't operate on a surface level data, they operate on the risk anticipation. Right now, there are three major risks. First, the oil prices. India is heavily dependent on oil imports. If the crude prices spike due to geopolitical tensions, inflation can rise very quickly, even if everything looks stable today. Second, global uncertainty. When global economies slow down or become unstable, capital flows become unpredictable. Now that puts the pressure on currencies like the rupee. Third, currency stability. If the RBI cuts the rates too early, the rupee can weaken further because global investors will move money to countries offering higher returns. So, from RBI's perspective, cutting rates early is not relief, it is risk creation. That's why they are holding. Every interest rate cycle silently shifts money between groups, and most people don't even realize which side they are on. In a high interest rate environment, banks earn more because they lend at high rates. People with savings earn more through fixed deposit and debt instruments. Cash becomes powerful. But on the other side, borrowers suffer because EMIs stay high. Home affordability decreases. Business find it expensive to expand. So, what looks like a neutral policy decision is actually a transfer of money from borrowers to savers. If you are not aware of this shift, you will automatically fall on the losing side. So, most people right now are doing one thing, they are waiting for the rates to fall, waiting for cheaper loans, waiting for a better time. But this entire assumption is built on an outdated belief that rate cycles reverse quickly. This time, the cycle is different because inflation is not just a domestic issue anymore, it is tied to global factors oil, geopolitics, currency movements, which means the timeline is longer and more uncertain. So, if you delay the decisions based on the hope of falling rates, you're not being patient, you are being passive in a changing environment. And passive players don't win in the financial cycles. So, now this is where the difference between average and smart investors show up. If you have a loan, you should stop expecting relief in short term. Instead, focus on reducing your interest burden actively through prepayments, restructuring, or better planning. If you are investing, this is one of the rare phases where low risk instruments start becoming attractive again. Fixed deposits, debt funds, they begin to offer meaningful returns. At the same time, equity markets may not give smooth upward moves because high interest rates reduce the liquidity. So, your strategy has to become more balanced and intentional. If you are planning a major purchase, don't base your decision on future rate cuts, base it on whether you can afford it comfortably at the current rates or not. Because if rates don't fall, your entire plan collapses. This is not just about loans, this is about understanding where we are in the economic cycle. High interest rates slow down borrowing. Slower borrowing slows down the growth. Slower growth creates volatility, and volatility creates opportunity. But only for those who understand what is happening only. Every financial cycle creates two types of people those who wait for things to become easier, and those who understand the shift and adjust early. Right now, the RBI has made one thing very, very clear easy money is not coming back soon. The only question is will you keep waiting or will you adapt before everyone else?